Hey everyone, Brian Bogner here along with Greg Towner, and we are excited to bring you a very special episode here, the state of the election year stock market. We all know it's election year. Okay, you've got to be, I don't know, maybe out in the woods for the last 2 years hiding under a rock to not realize that there's an election going on. And what we do a lot is we see these headlines, we see the news, we see all these things that are happening because there is a lot happening. And of course, we do get emotionally involved with these things. It's politics and we're very opinionated about them. And then we tend to make connections, right, with what we're seeing to other things like the stock market. And so we're going to be talking about the stock market today because a lot's happened here over the last couple of months. Big drop, big rebound, which we're going to unpack in detail with you. But one thing we are not going to be talking about because we're going to try to hopefully, which if you've listened to these shows, we've been saying for a long period of time, our messaging is, yes, these elections are important, but there's so many other things that you need to be looking at when it comes to your investments and your stock market. So we're going to attempt to do that today with you. Greg, you ready?
Yeah, I'm ready. Let's do it.
All right, let's go. Okay. So, what happened and why? All right. And I'm going to go over these four bullet points and then I'm going to hand it off to Greg here to fill in the details. But the S&P 500 dropped nearly 10% in less than 3 weeks. It dropped and it dropped fast, right? We saw volatility really spike hard up. Then there was some concern that the Fed wasn't really doing what they need to be doing. And then I know a lot of you don't follow the yen, and that's okay, but the yen carry trade, which believe it or not, has a huge impact on what equities do. There was a risk level there that got increased, but a lot of these things started happening fast. Okay, Greg, why don't you take us through it?
Yeah, I think we wanted to include a number of extra charts this time around, Brian, because it really helps tell the story. So this first one is the S&P 500 from the beginning of this year, but ending at the market low, which was August 5th, I believe it was, just to
Mhm.
give some perspective of how things were looking at that time. Like you said, the market had dropped nearly 10% in less than 3 weeks. The VIX spiked. It was just really a scary period because people didn't know what was happening, why was it happening, and all that. And so that's what we're going to try to answer today.
Right.
This is look at the VIX index. We don't need to get into exactly what the VIX index is, but basically all you need to know is it spikes when people are scared, and it really spiked in
Yeah.
a big way. Now we see that it came way back down as well. We'll get into that more as we go along. I think one thing that's important, we've shown a chart similar to this several times over the years, but it's always good to come back to this, we think. This looks at each of the last 20 years. The little boxes, the lighter colored boxes below are the maximum drawdown in the stocks in each and every year. So you'll notice the columns to the mostly upside, despite having good drawdowns in most years, stocks finished higher in what is it, 17 out of 20 years, I
Right.
believe.
Right.
So in any given year, you're going to have a drawdown. That's
Right.
nearly a given. But also, more often than not, the market is going to move higher. So that's just part of investing.
Now, Greg, let me ask you: was 2004 an election year?
Yeah, I see.
How about
Right,
2008? Now, 2008 was an election year. Not only would have a big drawdown, but the market finished down. But guess what? Had absolutely zero to do with the election, right? Real
right,
estate bubble, debt bubble was completely crashing there, right? Financial
right,
crisis. 2012 was an election year.
right.
2016 was an election year. Oh, we go to 20. Yes, we had a 34% decline, but guess what? But did it have anything to do with the election? No. That was COVID. I remember that market went down, came right back up. And then here we are in 24. So even in our most recent 20-year thing here of election years, which we're in right now, we've got a pretty good data set that we can base certain things off of.
And not only that, but you had the winners from both parties in multiple times
Right.
in those different elections you pointed out.
Right.
So,
Republicans won some of them and Democrats won some. You're
right,
exactly right. Exactly
exactly.
right. So the market's gone down, right? All right, let's rewind back to the Fed, right? How has it recovered so quickly from that?
Yeah, absolutely. So here's the updated S&P 500 chart. We're looking at this around August 21st now, very close to getting back to a new all-time high in the S&P 500. And so it happened just as quickly to the upside as it happened to the downside. And so let's go back to talking about that VIX index, the volatility index. It went up really fast, but we looked at this data about what happens when the VIX comes down really fast. So 9 trading day period, when it moved the fastest, we just had the most percentage change ever. If you look at all the other top 20 periods when it really declined rapidly, the average forward return for stocks is substantially higher than just all other time periods looking out forward. So it's as if everybody panicked, they got it out of their system, so to speak, they did the selling they want to do. And now I don't want to go so far as to call it the all clear signal, but essentially a lot of that fear has gotten behind you and the market can get back to business, so to speak, and move forward.
And this is a what, 34-year data set. And even if you look here, even in some of these reds 6 months out, there are a couple instances, but you
Right.
go a year out, and there's not been one instance where we've been negative. You're right.
Exactly. So, of course, we talk about sentiment a lot. There's a lot of different ways to look at it. This one looks at what's called the Investors Intelligence Survey. The blue line is the S&P 500. The red line is this survey. And we see that when there are low number of bulls in this survey, inevitably, just like recently, the market ends up being near a low point. It's not
Mhm.
always going to work exactly, but it's amazing how many times it does work. And so it's people get more negative, it tends to be gets to be more of a good point for stocks. And so far, it's held true again here recently, pushing the market higher. All right, so we know that the market got a little bit freaked out over some of the economic data after the last Fed meeting, and people were starting to get concerned. Oh no, maybe the Fed is moving too slow. They should have moved quicker. We really need this economic data to come in, nicely. So far, it has. The U.S. Consumer Price Index, inflation, came in under 3% for the first time in a while here recently. So that was a really positive sign for what the Fed is going to want to see and what investors want to see. We actually think there's more downside to that to come in inflation. We've talked about this type of chart before. The red line is how inflation is shown in the CPI itself. The gray line is actual rents by Zillow out there. The CPI takes a while to catch up to what's going on out in the marketplace. So we think there's more shelter data, as they call it, to come down further in inflation. And
Mhm.
not to mention gasoline prices are starting to come down and some other things.
Mhm.
So we think the inflation data is going to keep coming in the right direction and allow the Fed to cut rates here in the very near future. What the market also was happy to see as part of this recovery is some of the economic data was improving. There was manufacturing numbers, but what we're showing here is retail sales. We heard comments from a number of different retail-oriented companies, Costco, Walmart, Target, that said, hey, things are not so bad out there. Things are actually going okay for most people, not all, of course. But the retail sales number keep pushing higher. People, the US consumer, what do? They spend, right? And so there's keep spending.
Yeah, and they're spending money, no doubt.
Yeah. This one, I have to admit, surprised me, Brian. I think maybe it surprised you as well, because I
Did.
know we've talked with a number of advisors that have clients that are small business owners, and they are starting to get a little bit concerned, maybe seeing a little bit of slowness. This is a survey that just came out here in the last week, and it's a survey of small business owners and the kind of optimism that they have. And it's actually been moving up quite a bit here in recent months. So I think they're starting to get a sense that maybe by and large their business is turning the corner a little bit. I think the next chart we have might be part of the reason for this. This
Right.
is the 10-year interest rate note. So interest rates across the board have started to come down. They're likely to come down more. Certainly, the Fed rate's about to come down more. And small businesses are really tied into interest rate levels because they tend to take out more loans and that sort of thing. So I
Mhm.
think maybe small business owners are saying, hey, maybe business isn't booming for us, but we can see beyond this a little bit because we're going to have some cheaper money to have access to.
I mean, if you think about it, the very large, mega, big cap companies, they've got all kinds of ways they can raise capital. But for if you're a small business, you really don't have all those levers you can pull. You basically got to go to the
Right.
bank and they're going to tell you, okay, we can, first of all, they can do the loan, right? And if they can, here's the rate. And the rate is based on this, right? When we're up here, that their cost of capital to grow, to hire, to expand, whatever they need to do is much higher than it's normally been. So sometimes they take a breather. We're not going to do that. Or I don't know if there might be a little too much risk. So as these costs look like they're going to come down, right? A small business owner now really has a little more incentive to maybe build that extra expansion or hire some more people, do whatever they need to do to grow their business.
Yeah, of course, someone else that would like to see interest rates come down is people
Right.
that are looking to buy a home or perhaps refinance a mortgage. The 30-year mortgage was up pretty much 8% not long ago. Now we're down to about 6.5%. It wouldn't be at all surprised if this gets under six here in the not too distant future. And I think people that have been dragging their feet on buying a home, they see a mortgage that starts with a five in the front of it. They might be a little more motivated to get
Right.
out there, do a little bit. That helps the economy, helps push things in that
Yeah.
respect. Refinance applications frees up money. So I think this is a positive for the economy. Yeah, if you're a retiree, you're loving collecting that extra interest on your money market, you're going to take a little hit there. I think by and large for the economy, it's going to be a positive with these rates coming down some.
Yeah, no doubt. If you own a mortgage, if you own a mortgage right now, you're thinking about moving and you're paying 3%, and you're right, and your option's 8, yeah, that pretty much settles that debate for you. But a 5, oh, okay, that's not as too bad. You're right. That I feel like we're going to see some more supply coming into the market, which will hopefully bring some of these home prices down a little bit.
Yeah.
All right, so what to do with stocks near highs? Because if we go back to this chart here, the S&P 500, we're back to these all-time highs again. What's the question that we get asked a lot is, okay, do we invest? Should I invest here? Why would I invest here? Because stocks are at all-time highs. Actually, stocks near highs is usually a sign of strength, okay? And historically, buying stocks at highs equals stronger returns over time. Look, picking tops and bottoms, we always say it's a fool's game. Okay. And it's very difficult to do. Our very own Greg Towner here on this call wrote just recently, actually in the last month, published a white paper called Don't Fear Strength, Investing at All-Time Highs. And so what we wanted to say is, look, the market's at all-time highs right now. This would be a great time to read this white paper. We were going to show you a bunch of charts, and I'm like, it's in the paper. Let's just download the paper and take a look at it. If you just go to parallelfinancial.com/white papers, all, plural, it'll take you actually all the white papers that Greg has done, but definitely download this, take a look at it. It couldn't be more relevant than it is right now. So as always, thank you so much for watching today. You can find us here. You got our number, you got our email addresses. We're always available for any questions, comments, all those good things. Thanks so much. Download that white paper and have a great day.